think that would mean for the Dow index, the Dow Industrial Average rather? It's only comprised of 30 stocks. So, you know, if you only have a composite index of 30 issues in the stock market, one stock could make this average go crazy. One stock can cause it to go way up. And if a few of them out of the 30 go up, it's going to be wildly out of character for the other averages. So that's why I don't trade this one because it can be a little wild, a little unruly. Okay. The Dow's kind of like that girl that you couldn't get at the end of the bar, but the other one at the other side of the bar that no one's talked to, you've had a little too much to drink, but you don't want to go home. That's the one you're going to ask out because you're probably going to get it, no problem. That's what she is. She's the dirty 30. She's the white night. She's a one night stand. She's not. You're not going to take her home to meet mom. Okay, ladies in deference. You're not going to. You're not introducing this guy to your parents. Okay, but you're just going to go in there and look for a short term fling. Okay, real quick, scalp, get out and done. That's my perspective. That's the analogy I've always maintained with it. It's just a simple usefulness for intermarket relationships. Like I want to see it for Dow theory, supporting the idea of whether or not the market breadth is in fact good across all averages. But I have the least affinity or importance placed on the Dow. So if the market, let me make it very clean and clear for you. If the market does something like this, um, say we're in a bullish market condition, and this is the Dow. Okay, and we have a low that's been taken out, and say the S&P comparably does this, and the Nasdaq does that. If this is the Dow in the middle, S&P above it, and the Nasdaq is lower, in the time I'm expecting the market to be bullish, okay, the S&P has more stocks in it than the Dow and the Nasdaq. So by sheer brute force of how many contracts, or not contracts, but companies that are in the average or index that makes the S&P up. If it fails to make that lower low here, while the Dow does make a lower low and the Nasdaq makes a lower low, this is by theory, Dow theory, is the basis of SMT. All I did was incorporate that idea and some ideas I got from Larry Williams, and I've always said this: I didn't invent SMT. I just named it because it's like a smart money concept or technique or tool. And it's always, I've never settled on what the T stands for. It's always been interchangeably technique or tool because that part it's not mine. I never claimed ownership of it. I didn't care about it that much. And sometimes it's useful and sometimes it's not. But when the underlying premise is there for the market to be bullish and you get a criteria like this, that really many times signals the low, and that would be basically a turtle soup long below that low for Dow, a turtle soup long below that low for Nasdaq, and this is simply just an optimal trade entry for the S&P. The crack in correlation, meaning at the time when they all do not agree, when it's already bullish, when this failed low below that low, in other words, this is a divergence between these respective lows. If the S&P is doing this, then we're really bullish. If the premise is underlyingly bullish too. And what would that look like? Remember when I was showing you with the dollar index on the daily chart and I showed you how to frame the dealing range it's in? And then once that low was taken out, we entered this range that is the beginning and framework of a buy program when everything for my market maker buy model is going to form, all facets of it: the low risk entry, reaccumulation, second stage reaccumulation. All of those are going to be inside that range. Inside that little range of price action, when the buy program should manifest all the facets of a buy model or sell model if it's bearish. If you see this criteria in price action, it further presses the envelope of how fast and how hard it's going to go up because it's really indicating on all checkpoints that it's going to go up. Now, I do not, this is really important, I do not share the same affinity for being wildly bullish if this one is the Dow and this is NASDAQ and this is S&P, or vice versa. If the diverging average is the Dow, I don't care. There's many times where you'll see a divergence in the Dow, and you might look at that and say, "Oh, it's a SMT divergence, and it's going to cause all the averages to change." I have lost a lot of money trying to do that initially, and I've learned by lesson of money leaving my hands that the greater importance is placed on the S&P most, then the Nasdaq. I will take a SMT divergence or Dow theory, converge all the averages being confirmed with one another. In a perfect world, every low should be matched with the Dow, the Nasdaq, and the S&P. But there are times when one of those averages diverge. And the importance I'm trying to place on an emphasis on is if the divergence like this is forming when you're bullish and this is the S&P, that's kind of like a loaded deal. If it's the Nasdaq, I have affinity for that one, but it would be better if it would have been in the S&P. Sometimes both the S&P and the Nasdaq fail to do that, and the Dow will make that lower low. Does that mean the Dow is telling you it's weaker? Some of my students erroneously have thought that because they're rushing to believe just because there's a divergence or supposed divergence in the averages, they think that that's enough information. It's not. So hopefully I've corrected you and recalibrated your expectations as it relates to SMT or looking at the averages in this capacity.